Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah, and a slightly truncated version, but let me get in our guests on the show to try and tell us, almost do a tutorial with us. Now, whether or not the tax changes in the budget have had an impact or no, there is a lot of conversation around whether there should be a change in the way you plan and save for specific events. Those events could be less than 3 months. They could be between 3 and 6 months, between 6 and 12 months, between 1 and 2 years, or 1 and 3 years as well. So what to do or how to use the mutual fund route in the most optimal fashion to be able to do this. Praveen Bajpayee and Karthik Zaveri join in to talk about that. Both of you, thank you so much for taking the time out. Because we have paucity of time, I'm gonna jump straight to the topic and cut to the chase straight away. Praveen, let's start off with the shortest duration first. People wanting to save for something that is coming up within 3 months. So therefore can't use the SIP route. Obviously, it's a lump sum mode. What is the best option available right now post the budget? And if the taxation changes altered that route, then please advise us about the same.
Good afternoon, Neeraj. For 3 months, lesser than 3 months, or up to 3 months, I think safety should be considered first, and my choice would be an overnight or a liquid fund. So that's one thing, because you want to ensure that there is no volatility, there is no negative returns on the money that you have parked. If somebody, and of course here you're getting taxed at slab. If somebody understands the nuances of an arbitrage fund and the amount is really huge, and that 20 and 30% sort of a difference which is there in the taxation, that will make a big impact, then probably arbitrage can be considered. Otherwise, I'll go with a liquid or overnight.
Karthik, you've used overnight T-bills as well as the options here. What's the kind of return anticipated? And taxation at slab would mean what percentage? Would be lovely to clarify for our viewers.
So taxation slab is pretty clear, right? I mean, it's going to be 30% typically if you're in the large bracket, because these are the kind of people who want to park their money for a shorter period of time, whether you're a company or an individual. Now, very rare to see that an individual will be in a lower tax slab. So therefore, we'll go with the 30% plus surcharge and cess, as the case might be. Returns that you'd expect should be somewhere in the range of about 6%, give or take, on an annualized basis. But see, the good part is AAA, sovereign rating and things like that for treasury bills, which is essentially the part of this portfolio. So from that point of view, we don't want to lose any money. We don't want to have any negative adverse fluctuation. So in that sense, this is the best bet.
Okay. Karthik, I'll start with you on the 3 to 6 month journey. What is to be used and is this different pre-budget and post-budget?
Not so much different pre and post budget, because taxation broadly was the same all along, because in 2023 that indexation and those benefits were removed. So therefore, if you now look at short-term funds and short duration kind of funds, we should be pretty okay. What happens is the return inches up a little bit, a tad higher. So instead of maybe 6%, you're looking at about a range of 6 to 8%. The treasury bills from a short term, which were typically at 91 days, move up to about 6 months. That sort of a thing. So you get a little marginal benefit. No fundamental change with respect to the budget perspective. But at the same time, what happens is the diversity of your portfolio or the inherent asset in your portfolio just increases a little bit. So you will also have GOIs, you will also have some NCDs depending on the fund that you choose. But returns just go up a little bit more for you. So if you want 3 to 6, broadly the same category, but returns slightly better.
Okay. I'm going to spend some time on the next 3 time durations, probably because I would say that my whole newsroom plans for events, for holidays, for stuff, in a time period between 6 to 12 months. So I'm going to spend some time here, spend some time on 1 to 2 years. So probably now, this is my question. There is a bit of a certainty required to this return, maybe not as much as a bill payment, but let's assume people have to pay taxes and they want to plan it better if they are on a contract, or if they want to plan a holiday and they want to save so that they do not have to make a large lump sum payment. Let's say in the month of January, if they're planning a holiday then. I don't know how many people do that, but be that as it may. Maybe December is a better month. So let's just try and understand what kind of mode would you choose using the mutual fund route to do this? And are MFs the best place, or are there other options, Prableen? Maybe get in a bit of a personal finance piece here, but would you still use mutual funds, or are there other options here?
SIP is a very convenient mode, Neeraj, to plan your holidays because, maybe you're putting your money for 6 months, 12 months, and then you're utilizing it. Categories within debt, lots of them available. You can even use categories like ultra short duration, and then you have the low duration funds. So a lot of options for this 6 to 12 months within the debt space. And then, of course, you have the arbitrage funds. If we look at the returns, SIP returns over different time periods, for example, 2022 to 23, July 23 to 24 July for SIP returns, 4 categories: low duration, ultra short duration, arbitrage funds, and even money market funds. The SIP returns, XIRR, have all been, almost similar. So it's like a 6.8 to 7.01% kind of a range. So they're very, very similar. So I would definitely go with an arbitrage fund because of the advantage that it offers, which is still there, the 20% taxation. Second thing, Neeraj, here, that if in case my holiday gets extended, or I postpone my plan of using these funds and I'm using, let's say, my yearly bonus, then I cross that 1 year, and if that SIP continues and can stay on for longer, I'm then cleanly using the equity, the 12.5% taxation later on. So I think that's an added advantage. Only certain specific periods, what I saw in the past, where SIP returns for arbitrage have been much lower. That was the period of 2020 COVID. But I think across categories, that is a year where we shouldn't be taking it as an example because, a lot of variation was there. Otherwise, the returns, SIP returns, are almost the same. So I'll pick arbitrage for this period and the purpose.
Okay, so 6 to 12 months, viewers, remember, and short-term capital gains tax applies, so no longer at 15% but at 20%, so bear that in mind. Okay, we have about 4 minutes, so I'll jump categories now. I want people to take views from both of you on all the categories. Karthik, I'll go to the 1 to 2 year slab with you. And again, a lot of people might be thinking, okay, this December is too close, so maybe do something else, but next December, so I have about 15 months or 16 months to plan, and I want to use the SIP route to plan for that expense that will come up in December 2025, right? What mode of instrument or what route would you choose? I also want to ask you, Karthik, a follow-up there very quickly, simultaneously. You do not have arbitrage funds within your choice of funds at all. Why would that be?
See, the thing is, the answer to that question is very obvious, because when you are suddenly looking at a time frame which is 12 months and beyond, you want to have a better rate of return, because then you are saying that why should I go to a mutual fund? Why don't I just stay in an FD and be very happy about it? So that's the reason then you need to look at slightly more sophisticated products than even your traditional debt funds, because you automatically have that expectation that you want a little better return. So my sense would be to go to hybrid products, but which are more the conservative variety, which have that 35 to 65% equity, because it's that equity percentage which will actually add the little spice into the whole investment and basically bring your returns up as much as about 8 to 10%. So balanced advantage is one category, and your hybrid conservatives are another category, to my mind, which I would like to recommend. So do the SIP. By all means, they all do lump sums, do, as you like. Just bear in mind, what happens is here, the long term will only kick in after 2 years, not before 2 years. And so long as you redeem this investment within the 2 year slab period, the time frame period, then obviously you'll be taxed at the slab rate. So that's the only thing to take care of. But returns are great, expectation is met, and rewards are also sort of delivered in that space.
Okay. So Karthik, very quickly, 30-second answer. You don't want to recommend names, but can people search for a balanced advantage fund at any portal that they use and get one of those many choices in which they can use to invest?
Yeah. So typically the popular portals are your Value Research Online, your MF, Money Control, etc. Yeah, you can by all means do that. Search for a balanced advantage fund, search for hybrid conservatives, and there's so much of variety. Hybrid, moderate, hybrid, balanced. These are your search words, and you'll get a lot of variety, a lot of options. Most of the mutual funds have it, so I think you shouldn't be restricted with respect to choice.
Okay, Prableen, last question, and we have a minute and a half. Maybe a couple of examples of the arbitrage funds, if you can, and what would you do? Part 2 of my question, for 1 to 3 years.
So the second part first, Neeraj, 1 to 3 years, definitely. If your risk appetite allows, it would be hybrid funds, it would be the multi-asset allocation funds and the balanced advantage funds. Clearly, for the returns, because you are looking at slightly higher returns, and of course, the tax advantage is there. So that would be choice for 1 to 3 years. For somebody who's really looking at the low risk and is okay, with sort of higher taxation, debt funds are okay, but looking at lower return risk as well as lower taxation than arbitrage funds. So depending on the risk appetite, so hybrid funds for somebody who can take some exposure to equity, clearly multi-asset as well as the balanced advantage. A few names from arbitrage, I would go with the bigger names, Neeraj here, the SBI, Kotak, ICICI, Tata. I think these are some of the credible names within the arbitrage. And within the multi-asset and balanced advantage, again, the conservative side would be names like you have Nippon, then you have ICICI, you have SBI, and of course, these are some of the good names out there. And investors can actually, even Parag Parikh, they've come up with a slightly conservative balanced advantage. So I think these are some of the funds that investors can look at, but after doing their own due diligence.
Most importantly, please do that, viewers. And I'm sorry we had to do a bit of a rushed episode today, but earnings season compulsions. But thank you so much for being with us and giving us your thoughts. Both of you, really appreciate your time. And viewers, I hope you found this as useful as I found it today. Thanks so much for tuning in.